Understanding Investments a Few Minutes at a Time by Daniel Dower. From Chapter 11, Options, Issue Number 48, Put-Call Parity. A long story made short. Due to the opportunity to arbitrage options against their underlying stock and one another, puts and calls on the same company at the same strike price and expiration date will maintain a certain price relationship in respect to one another, such that their return profiles are the same. If you intend to use options, definitely research this issue further in a more specialized forum. Despite this academic fact, in real markets slight differences will exist even between securities that may be arbitraged. Options combinations. Options may be combined in a variety of ways, each with their own names to assist discussing them. Due to put-call parity, each can be expressed as some combination of stock, call, and put in separate ways. Below, I've illustrated only the few most common combinations, but this practice includes terms you may have heard: butterfly spreads, strangles, collars, synthetic stock, etc. A covered call, or buy right, is when one purchases the underlying stock and sells a call on the same stock. This technique is most often used by someone who wants to own the underlying stock, but at a lower price. In exchange for offering the upside over the strike price to the buyer of the call, the seller receives the option premium up front, reducing the cost of the investment. The parity put version is a cash-covered short-naked put. A protective put is when one purchases the underlying stock and a put on the same company. It is usually used by someone who wants to limit their downside exposure. In exchange for paying a premium today to buy the put, its owner maintains the right to sell the underlying stock they own at a strike price, guaranteeing a minimum value for the investment through the expiration date. The call version is to purchase a call and set aside cash sufficient to exercise the call if desired. Whole books analyze various option strategies. This book intends only to introduce options as a tool for investing. Like any other tool, they are not inherently good or bad, safe or risky. Don't blame the tool, understand it. One can use a screwdriver to fix a table leg or to poke oneself in the eye. Unfortunately, options were not widely used during the early 20th century and are not prominently discussed in security analysis.